We think of modern crypto as a pristine digital vault, regulated, institutional, safe. But pry open that polished exterior, and you'll find chaotic, grinding clockwork. The industry wants you to believe we've reached an era of complete stability. Yet, in March of 2026 alone, we saw $178 million wiped out across major security incidents. The days of passively earning triple-digit returns just for holding a speculative token are over. That early adopter window has closed permanently. As baseline yields compress to single digits, technical exploit complexity goes through the roof. Hackers aren't breaking smart contracts anymore. They're using sophisticated social engineering, tricking users into authorizing spend permissions directly to the attacker. Assuming your capital is safe simply because the market is now regulated gives you a false sense of security. The risk didn't disappear. It just shifted from volatile prices to complex systems. It is true that digital assets are now integrated into global banking. Policymakers have spent years hammering out the rules, and the legal foundations are finally setting in place. Looking at this PwC regulatory table, you can see extensive legislation and licensing requirements are firmly established across the US, the EU, and the UK. These rules have legitimized private stablecoins for banks and fintechs, creating ultra-safe, low-yield rails. However, the search for higher returns has pushed more technical capital into unregulated yield engineering zones, splitting the 2026 market into two completely different environments. To survive this landscape, you have to map exactly which of these strategies matches your specific technical bandwidth and which will drain your account. Entering this environment without objectively assessing your own capability is dangerous. If you don't know exactly what game you're playing, you're going to end up as the exit liquidity for institutional algorithms. Let's start with the pro-DeFi route. This is built for the highly technical yield engineer who wants to maximize capital efficiency without caring if the broader market goes up or down. The prime strategy here is delta-neutral farming. You deposit a stablecoin on a lending platform, perfectly offsetting that exposure with a short position in perpetual futures. This exact balance extracts a steady stream of yield, totally ignoring market volatility. But this is not a set-and-forget investment. It demands constant, active risk management. Your exposure lies in sudden funding reversals. A sharp market move can cause execution errors, quickly turning your steady yield into a massive loss. Delta-neutral setups trade price volatility for operational complexity. They are effective tools for full-time yield engineers, but utterly toxic for passive investors. For those chasing maximum capital efficiency, the market has developed restaking and layered yield. Here's how it works. You stake a base asset like Ethereum and receive a liquid receipt token. You then recursively deploy it into new protocols. This layered approach keeps capital hyper-productive, stacking staking rewards, incentives, and fees into one combined return. The trade-off is massive rehypothecation exposure. Because these assets are inextricably linked, a single flaw anywhere in the chain threatens the entire stack. We saw this play out with Resolve Labs. A logic flaw allowed attackers to mint unbacked tokens, causing an $80 million collapse. Restaking amplifies your returns, but it forces you to accept catastrophic systemic contagion risks that you simply cannot predict by reading a price chart. Pivoting to the compliance-first world of corporate treasuries, the focus shifts entirely to tokenized real-world assets. Institutions use regulated stablecoins and smart contracts to execute instant settlement and automatically distribute corporate dividends. This architecture bypasses traditional bureaucratic bottlenecks, cutting out long processing times and navigating international taxation. This table highlights the points of divergence in global rules. Compliance requirements for reserve compositions and holding limits change drastically, depending on whether you are operating under frameworks in the UK, the EU, or Singapore. The TradFi route completely sacrifices high-yield upside. Instead, it chooses to optimize back-end operational efficiency inside strict, localized regulatory perimeters. Regardless of the strategy you choose, the vast majority of private user losses in 2026 share a single common factor: the exploitation of trust. Modern apps require you to sign permit approvals. Attackers bypass complex smart contract code now. Instead, a single click on a phishing link grants an attacker the permit to irreversibly drain your funds. This trust layer vulnerability affects everyone, from retail to pro. multiple 6- and 7-figure user exploits in March 2026 proved that human error, not code failure, is the primary vulnerability. Because these attacks abuse the exact mechanisms designed for convenience, vigilance at the user interaction layer is now your single most critical security requirement. Let's bring this all together to match your risk profile and technical bandwidth to a specific roadmap. If you are a passive retail investor, do not blindly copy complex engineering strategies that you don't have the time to monitor. For the institutional allocator, your path leads directly to regulated stablecoin infrastructure and real-world asset dividend frameworks, operating strictly under clear regulations like MiCAR. For the pro-DeFi yield engineering, delta-neutral and layered yield strategies are valid, provided you utilize strict hedging and constant active monitoring. Attempting to execute a complex strategy that is mismatched to your operational capability guarantees you will take on institutional-grade risk for retail-grade returns. To finalize your playbook, institutional players must confine all treasury activity to the established, regulated perimeter to avoid exposure to decentralized contagion. Successful yield generation in this environment is a high-stress, full-time risk management profession. And for everyone operating in this space, there is a mandatory security protocol required to defend against trust layer exploits. Your cold storage vaults must be strictly separated from your active interaction wallets. This acts as a necessary firewall against malicious approvals. Closing these vulnerabilities is the only way to protect your principal capital. By 2026, crypto has fragmented into a specialized toolset where longevity is dictated by how accurately you evaluate your own limitations.